Today, we'll be talking about the most misunderstood part of the mortgage industry, and that is temporary buydowns.
So enthusiastic.
I know.
I love that. Love that enthusiasm.
We got 15 minutes to go over this, so yeah, let's do this. So yeah, in today's, I guess, landscape
segment,
yeah, we're going to be talking about buydowns, which is a very popular product that's that you're seeing used a lot because where rates are. And so let's talk about the different options that
different types of buydowns.
Yeah, and what it really does to a buyer's payment.
Well, so there's two types of buydowns. There's a permanent buydown where you're just basically paying points, discount points, to buy yourself a permanently lower, let's say, fixed interest rate or whatever you're doing it for. That's a one-time cost for obtaining a slightly lower interest rate for the life of the loan. That's a permanent buydown. There's a temporary buydown, which is another situation where there's a certain amount of money put up front, and then that's going to buy you a temporary situation where for either 1 year or for 2 years, or in some cases 3, and it could be graduated, interest rate options where you're going to have lower interest rate for a certain amount of time, and it may graduate back up to a certain interest rate for the rest of the life of the loan, let's say.
And so what I think that the audience needs to understand is that this temporary buydown it cannot be paid by you. This has to be paid by the seller, the agent, or come through a lender credit.
A credit, yeah. It can't be paid on behalf of the buyer. So why? So why is that? And the reason that is because if you think about it, how the temporary buydown works is you have your loan that's, let's use a regular fixed rate loan as an example, a 30-year fixed rate loan, and you have a note rate on that loan, and that's whatever that is. Let's call it 6% interest for 30 years, and that's what the interest is by the terms of your loan for that 30 years. That's pretty straightforward. So a temporary buydown, let's use an example of a 2-1 buydown. That is where
wait, stop. That's actually explain the different buydowns first before we get into the scenario.
Okay.
So like how it is the 2-1, 1-1, 1-0, 3-2-1. Let's kind of break that down first before we dive into actual program.
Okay.
So let's have you explain a few of them, and then I'll explain a few of them.
2-1, 1-0. Yeah. So if you think about it like this, it's a 2-1, 1-0. This all sounds like so damn confusing, doesn't it? 2-1, 1-0, 1-1, 3-2-1.
I think the 1-1 is probably the most confusing because it doesn't even make sense with the other ones.
1-1, 2-3, 1-2.
Yeah. It's like it's too many numbers for everyone.
Yeah, if you wrote it on a board, it's going to be like a 1, a 2-1 is a 2 and then a slash and a 1, and that means that like 2/1, and then that means that for the first year, you're going to pay an interest rate that's 2% below your note rate. Like I said a minute ago, 6%, let's say. So for the first year, it's at 2% below, slash the second year, it's at 1% below your note rate. Okay. 2% below the first year, 1% below the second year, and then at your note rate for the rest of the 30 years. Right?
Yep.
Okay. So in other words, so we got 6% interest rate. For the first year, 2% below, it's at 4. So your interest rate's at 4% for the first year. Year number 2, slash the second year, 1% below. Now it's at 5% interest for that year. Okay. And then here comes year number 3. That's it. We're at 6% for the rest of the time. How is that? Okay. So what does that even mean? Like obviously your payments are lower. So there's a cost for it, right?
Yep.
So what's the cost for it? Well, this is a little bit of a shuffle because the cost for it is what is the difference in the payment between 6% and 4% that first year? What's the difference in the payment? Let's say that difference in the payment's $500. Okay, a month, $500. $500 times 12 months for that year is 5 times 12 is $6,000, right? So that's going to cost $6,000 to do that for that first year. Okay. The second year, it's going to be, let's call it half that. It's $3,000 because say your interest rate movement, right? So we got $6,000, $3,000. That's $9,000. And that thing to do that for those 2 years is going to cost $9,000. It's got to come from, be paid for by who?
The seller,
somebody else.
Yeah, someone else other than yourself.
Someone else other than yourself.
And the thing is too, so there's, like you said, there's about four or five different ones. So the 3-2-1, the 2-1, the 1-1, and then the 1-0.
Yeah.
And all of them, I think the most popular is that 2-1, which is the one that you're talking about right now. And that's kind of like the mid. I think that's the middle range.
Yeah.
And it helps out a lot of the time for the first time buyers, because that 2% the first year really helps out, because they're used to most likely paying mortgage about half of what their new payment's going to be. So it kind of like gets them into it to like slowly, gradually get used to that that payment, or what they're going to be looking at in year 3 if they do not refinance.
Yeah. I mean, personally, my perception it's a tool like anything else. It's a little bit of I'm not going to call it a scheme at all, but it's kind of like that, because really the reason that it doesn't make sense that the borrower isn't allowed to pay for it is
you're paying yourself.
You're paying yourself then. So you're all like, if I were to have a loan that's at 6% forever, right? And I'm going to have a little bit of a discount on it for the first 2 years. Okay. But I'm literally taking money out of my pocket and this pocket and putting it over here in this pocket to pay for that discount for those 2 years. Like, how does that make sense to do?
Yeah.
Right?
It doesn't make sense at all.
You're not really doing anything for yourself. For that matter, you had the money, you could have just made the payment all the way through.
Yeah.
Right. So that's why it's a great sales tool. It's a great marketing tool. It's a way to help people get in. If you're buying a property, it's been on the market, the seller is motivated to sell. Hey, can you, how about I'll offer you your price. How about you do this for me? Work a credit for me that's going to help me, with helping my payments be lower for the first year or two, something like that during the meantime. And then that's a situation where that kind of makes sense, right?
Yes.
It just doesn't make sense for you to pay for it yourself, which is why you're not allowed to do that necessarily.
And then also, I think this program in particular, me personally, I've used the 2-1, and I've had a lot of borrowers also use the 2-1, and it a lot of people think that like, oh, you can only use it if you're a first time buyer or whatever. No, you can use this across the board. It doesn't matter.
Sure.
What range you're in, you can use it. You can take advantage of it. Is there going to be a cost associated, like a difference in cost at different price points? Yes, there is. But ultimately, it's a great resource if you're if you're paying right now $2,000, and then you're going to a $4,000 payment. That may
be tough.
That 2-1 buy down may make you feel a little bit more comfortable those first couple of years. Yeah. So, I mean, I think
you do have to qualify.
Yes.
For
the higher
one, yeah.
Higher payment. But the thing is, I think it's a great resource just to, get in there and maybe the whole buying process is stressful as it is. And to be able to okay, my payment's only going to be, $1,000 for the one I'm used to paying, it's not such a shocker as, if you had to pay the full.
Well, it could be useful in a situation too, where let's say you're in an industry or a new job or something like that, where you're going to be kind of going up the pay scale in a couple of years. You got to qualify for the note rate no matter what. But it kind of gives you a little bit of a head start, or a little bit of a kickoff of having a little bit lower payment for a while you work your way up the income scale as well. So that could be a use case where it makes sense to do.
I agree. So if you guys have any questions about temporary buy downs or anything like that, or you want more information about it, leave us a comment, DM, and we'll go from there.
You bet.